Here the question is X and Y are partners in a firm sharing profits in the ratio of 3:2. And the last line tells us prepare journal entries, past journal entries, prepare capital accounts and opening balance sheet. Very good question. Working notes, old ratio of X is to Y is equal to 3:2. Z is admitted for 1/6 share. Let the total profit share of the firm be 1. Remaining share of X and Y after Z's admission is equal to 1 minus 1/6. Here is Z is taking 1/6 out of a total 1 share. Z is taking 1/6. Hence remaining is 6 minus 1 upon 6 is equal to 5/6. Excess new share is equal to 5/6 multiplied by 3/5, that is equal to 15/30. Y's new share is equal to 5/6 into 2/5, that is equal to 15/30. Z's new share 1/6 multiplied by 5/5, that is equal to 5/30. Therefore, the new ratio of X is to Y is to Z is equal to 15 is to 10 is to 5, that is equal to 3 is to 2 is to 1. Sacrificing ratio is equal to old ratio minus new ratio. Excess sacrifice is equal to 3/5 minus 15 upon 30, that is equal to LCM 30. 6 3 is 18 minus 15, that is equal to 3 upon 30. Y's sacrifice is equal to 2/5 minus 10/30, that is equal to LCM 30. 6 2 is 12 minus 10, that is equal to 2/30. Therefore, sacrificing ratio is equal to 3:2. Now, goodwill of the firm, you can read out the question. This is adjustment point number 7. Goodwill is valued at 1.5 years purchase of the average profits of the last 3 years less 12,000. Profits for the last 3 years are given rupees 10,000, rupees 20,000, rupees 30,000. Now, goodwill of the firm is equal to average profit into years purchase less 12,000. Total profit, here average profit is total profit by total years multiplied by years purchase minus 12,000 rupees. Now 3 years average profit rupees 10,000 plus rupees 20,000 plus rupees 30,000. This is 60,000 by 3 multiplied by 1.5 years purchase. It is written 1.5. To this half you can write down 0.5. 1.5 years purchase minus 12,000, that is equal to LCA, that is equal to good 12,000. Average profit is rupees 20,000 multiplied by 1.5 years minus 12,000 is equal to 8,000. Z's share of goodwill is equal to rupees 18,000 multiplied by his share of admission in new partnership, that is 1/6, that is rupees 3,000. Now, fair notes we have to prepare. Actually, fair notes should be prepared just before the balance sheet. This revaluation and capital account are there in the working notes. Revaluation account, you have to draw the proper format, and the first one being to bad debts, that is given to us in the adjustment, that to adjustment to write off bad debt amounting to rupees 6,000. Bad debt is a loss. Debtors are not paying and flying away. Hence, if they could not pay or they did not want to pay or we could not recover, that is a loss to the firm. It is debited to revaluation account. Next one is outstanding rent rupees 1800. It is adjustment number 6. Outstanding rent to be brought down to 11,200. Out of this 13,000, first item in the liability side, it became 11,200. This is decrease in outstanding rent by 1800. By outstanding rent 1800, this is decrease in rent. This is decrease in rent means increase in income, hence by outstanding rent. Next one is to outstanding damages rupees 2,000. To outstanding damages rupees 2,000. Increase in expenditure or liability. Damages increased. This is a loss or expenditure to the firm. To outstanding damages rupees 2,000. Next one is to creditors, because adjustment 4 tells us creditors are to be paid rupees 2,000 more. Increase in liability is a expenditure or loss to the firm to creditors 2000 rupees, and the last one being by provision for debtor doubtful debts rupees 4000. It is written in the book less provision for doubtful debts. Here the doubtful debts will be nil, bad debt became 6000. Hence we are expecting there will be a liability, there will be a bad debt of up to rupees 4000, but this became 6000. We have written in the debit side to the bad debt, and this provision is no longer required. This provision was there to tackle this bad debt menace, but this provision for a bad debt is now 4000 will be nil. It is now nil, hence decrease in liability. It is credited to revaluation account. Now our work is over. Total the debit side of revaluation account, that is coming rupees 10,000. That is coming rupees 10,000. Write it in the credit side rupees 10,000 and minus 5,800 by capital accounts revaluation loss transferred in old ratio of X is to Y 3:2. X is equal to rupees 4,200 multiplied by 3 by 5, that is rupees 2520, and Y rupees 4,200 multiplied by 2 by 5, that is rupees 1680. These two total amounted to rupees 4200. Now your capital account, draw the proper format of capital account of XYZ and write down by balance brought down for X and Y rupees 50,000 and 6,000. This is 60,000. This is the opening capital balance. Now the next one being by cash account, it is written in the first adjustment Z is to bring 40,000 as his share of capital, but unable to bring any amount for goodwill. By cash account 40,000. The journal entry is cash account debited to Z's capital account and unable to bring any goodwill, and we have valued goodwill at rupees 3,000. That will be distributed in sacrificing ratio of 3:2. Hence by Z's capital account, before that we can treat there is a loss appearing in the asset side of the balance sheet 4,000. X capital account debited, Y's capital account debited to profit and loss account, being loss written off in old ratio 4,000, 2,400 and 1,600. Next one being to revaluation account loss, that is 2,520 for X and for Y it is 1,680. It is revaluation loss is shown in the credit side and transferred to debit side of a capital account. Then your great goodwill treatment, I have marked with a different color by Z's capital account. This 3,000 we have already found out, that will be distributed in sacrificing ratio of 3:2, that is rupees 1,800 and 1,200. In the debit side to X's capital account and to Y's capital account in the column of Z rupees 1,800 and 1,200. We could have done it like this by Z's current account in the credit side. This is finished, but usually we do this at the time of a capital adjustment by Z's current account, and it will not be shown in the debit side, and Z's current account will be shown in the asset side. And in this question they have solved in this way, but I have solved it in little bit different manner. That's why you can follow uniformity in solving the questions by Z's capital account. Next one being by workmen's compensation reserve. It is in the liability side. We have workmen's compensation reserve 5,600. Out of this, workmen's compensation liability amounted to rupees 3,000. Read out adjustment 2. Claim on account of workman compensation is 3,000. Hence deduct 3,000 out of the workman's compensation reserve of 5,600. Then this 2,600 is to be distributed. This is by workman's compensation reserve. Then we have to add the credit side, and that will be taken to the debit side. We will be finding the difference. Two balance carried down. That is for X rupees 48,440, for Y rupees 58,960 and Z rupees 37,000. And in this balance sheet of the new firm as at 1st April 2017, in the asset side we will see cash was 10,000 and now she brings in 40,000 as is in new capital. Hence it will be 50,000. Next item is sundry debtors less bad debt 6,000, and provision for bad debt went off, and we are getting new debtors, sundry debtors new value, revalued value, that is rupees 74,000. Next one is stock 20,000. Next one is machinery, rupees 38,600, same old values. Now come down to the liability side, outstanding rent, new revalued value brought down to rupees 11,200. Workmen compensation claim 3,000 due to adjustment number 2. Creditors increased by 2,000, new value. Claim for damages, new item, rupees 2,000 in the liability side. Capital accounts X rupees 48,440 and Y rupees 58,960 and Z rupees 37,000. The total amounted to rupees 1,44,400 and total the balance sheets both sides, that is rupees 1,82,600. And journal entries, date, particulars, ledger folio, debit, credit with rupee symbols. First one being 2017, 31st March, cash account debited to Z's capital account 40,000 each, being capital received in cash from Z. Z's capital account debited rupees 3,000 to X capital account rupees 1,800 to Y's capital account rupees 1,200, being premium money not received from new partner, transfer to old partner's capital account in sacrificing ratio. Then profit and loss account appearing in the debit side at rupees 4,000 is to be written up to old partner's capital account in old ratio, that is to excess capital account 2,400, to Y's capital account debited 1,600, to profit and loss account 4,000, being profit and loss account written off in old profit sharing ratio among old partners. Next one being workmen's compensation reserve is given to us in the liability side at rupees 5,600. Workmen's compensation reserve account debited 5,600 to workmen compensation claim account rupees 3,000. It is the claim which is in the adjustment point number 2. This much amount will be kept in the liability side of the balance sheet, and whatever rest 2,600 is left out will be shared among old partners in old ratio. To excess capital account 1,560, to Y's capital account 1,040. Being workmen's compensation reserve distributed among old partners in old profit sharing ratio after deducting claim. Then same journal entries will be continued. In the revaluation account, reserve for doubtful debts account debited 4,000 in the credit side it is there. And outstanding rent account debited rupees 1,000 to revaluation account rupees 5,800, to revaluation account 5,800, being decrease in the value of provision transferred to revaluation account. Next one is debit entry, revaluation account debited rupees 10,000, to bad debt 6,000, to outstanding damages 2,000, to creditors 2,000, being decrease in the value of assets and increase in the value of liabilities transferred or debited to revaluation account. And the next one will be loss on revaluation transferred to capital account, debited to capital account, that is excess capital account debited rupees 2,520, Y's capital account debited 1,680, to revaluation account 4,200, being loss on revaluation transferred to old partners capital accounts in old ratio. And journal is always to be total at the end, that is rupees 72,600. And this is the final answer.